The core investing principles we're going to cover in this video are diversification, quality investments, risk management, and timeline and patterns. For the past few years, we've seen some unprecedented developments take place in the stock market, and with them has come a lot of uncertainty. On one hand, tech stocks have driven most of the growth in the past 2 years thanks to the AI wave, and this trend is expected to continue. Indexes like the S&P 500 have become extremely tech overweight, and many tech companies are currently valued at all-time highs. And on the other hand, we have some of the most uncertain geopolitical and economic context in decades, with wars both in the Middle East and Eastern Europe and uncertain interest rates. Inflation is still very present, and in countries like the US, the end of the student loan forgiveness program is expected to shave off $100 billion of consumer spending in the coming years, and probably greatly reducing companies' profits. Nobody can predict the future for sure, but we all want to be safe, right? A strong set of core principles when approaching an investment strategy can help optimize chances of maximizing profits on one hand and minimizing losses on the other. So let's get started. The first pillar is diversification. Diversification at its core is very simple to understand. Don't put all your eggs in the same basket, because if the basket drops, you'll lose everything. If you put your eggs in 3 different baskets and one falls, you've only lost 33% of your eggs, a third of it. When investing in the stock market, diversification is the practice of spreading your investments around so that your exposure to any one stock is limited. When we're talking about investing in the broad sense of the term, diversification is about investing not just in stocks, but also in things called bonds. A bond is essentially a loan from an investor, so that would be you, to a borrower, such as a company or a government. It differs from investing in a stock because when you buy a stock, you just hope that it will increase in value. With bonds, in theory, you make money on the interest you get as the person loaning the money. Within those two categories, stocks and bonds, you want to pick a bunch of different variations in order to minimize, again, your exposure. When talking strictly about stock investment diversification, you want to pick a bunch of different industries and usually look at the top players in each field. With this approach, it's good to look at the expected trends for each year and adjust your industry allocation accordingly. For instance, in 2024, tech is expected to continue to dominate, so slightly increasing your position there could be an interesting option. Energy stocks are also expected to increase due to the energy crisis, but consumer spending, on the other hand, is expected to decrease due to high inflation. Again, these are only predictions, and the odds that they will all be correct at the same time are pretty low. But if only one turns out to be wrong, you're still in the money, and it's very unlikely that they will all be wrong at the same time. The second pillar is making quality investments. There's no point in spreading your eggs across different baskets if they're all rotten to start with, right? One of the downsides of diversification is that it's very easy to use it as an excuse to place a bunch of bad bets that will lead nowhere in 90% of cases. Best way to diversify is to do it by only investing in companies that match this criteria: limited debt and strong balance sheets. This may sound a bit technical, but you don't have to be an expert to look up those numbers, and you don't even have to understand everything they entail. We just all know that it's better to have cash at hand for a rainy day, and that it's better to make money than to owe money, right? The less debt a company has, the less trouble it will have when the economy takes a downturn and when interest rates rise. Pricing power. Pricing power is a very interesting concept that's often overlooked by investors. It is the ability of a company to raise its prices without negatively affecting demand or high profit margins. For instance, insurance companies raise their prices every year to match inflation, and they don't lose customers because of it. Everyone just goes with it, right? It's a lot harder to replicate these kind of price increases with consumables. In the tech world, for instance, Apple has been steadily increasing the price of their iPhones, and consumers have kept buying them so far. But unlike insurance companies, this model is a lot more likely to come to exhaustion once people realize that they don't want to pay $1,000 plus for a phone anymore, especially when the extra product value you get for the ridiculous price increase is very little. The third criteria to make quality investments is to only invest in companies that have decade-long track records or longer. The longer a company has been around, the more it has gone through, and the better it will handle economic and financial headwinds. Long-standing companies are especially good investments when their stock price drops as a result of a PR storm, bad management, or simply due to market conditions in a specific industry. And who doesn't like a good bargain on a quality stock, right? With the current uncertainty going on in the different markets around the world, by the way, there's a lot lot of opportunity in this third criteria. Pfizer, for instance, has been around for over 180 years and it's currently trading at a price not seen in 10 years. That's a huge discount. 3M has been around for well over a century and it's also trading at a more than 10-year low. Whirlpool was founded in 1911 and is trading very low right now, and it's dropped 50% in value in the past 3 years. The third pillar is risk management. Risk management is the process of identification, analysis, and acceptance or mitigation of uncertainty in investment decisions. You cannot dissociate risk from return in the investment world, and you can never know for sure if your bet is going to be a winning one. But what you can do is draft up a worst case scenario in which you lose X% of your investment and anticipate whether or not you could afford such a loss. That's where most people fail to optimize their investment. They only think of the potential upside and they don't think of how much they would lose if they turned out to be wrong. Here's an example. Say that you want to invest in a stock that's been doing terrible for the past few months. The company has been around for almost 100 years and you think the bottom of the curve is near and will pick up again next month or very soon. You see some upside there. But what if you were wrong? What if next month was going to be terrible too? Even worse maybe. A good idea here, in order to calculate your risk, is to look at how much the stock may drop on a typical bad month. You can also look at how many consecutive months the stock has dropped in the past to get an idea of whether or not it could drop even more. There are plenty of tools to do this online. I use mostly TradingView and I will put all the links in the description down below. In this particular case here, we see that the stock rarely drops more than 10% even on its worst months. So if you decide to invest, for instance, $2,000, you need to ask yourself if you could potentially take a $200 loss and never see that money again. If you think even more long term and you think you can afford to not sell, even if it goes really bad, you'll maximize your chances of recovery, and that's the last pillar we're going to talk about. Timelines and patterns. Just like Rome wasn't built in one day, a portfolio doesn't create consistent wealth in a few weeks. It's good to manage risk as we saw, but it's even better to be patient. If you hold on to a losing investment long enough, chances are the stock will just recover and you'll end up making a profit anyway. But this can take months or years. You have to be very patient. But when you look back 10 years down the line and you've done 100% on your investment, you'll be happy you didn't sell right now in this moment where it's doing really bad. One key investment strategy when it comes to long-term thinking is the dollar cost averaging approach. The dollar cost averaging approach consists of investing the same fixed amount regularly regardless of how the economy is performing. If you had started with $1,000 and invested $400 every month from 2010 to right now, your portfolio would have only lost 18% of its value during the peak of the pandemic, while the S&P 500 lost more than 30%. That's the power of long-term thinking right there. Holding on to your investments for a long time using the dollar cost averaging approach has the double advantage of minimizing the impact of economic downturns on your portfolio, all the while creating exponential returns during periods of growth. That's it for this video. Thanks a lot for watching. I hope you found this content useful, insightful. If you did, remember to like and subscribe if you're not already. It helps me grow the channel. It motivates me to create more content. And yeah, that's it. Thanks again for watching. See you in the next video. Have a great rest of your day.